We're breaking down a really staggering case of internal fraud today, this one at IDFC First Bank. And this story, well, it's about an institutional failure that raises some critical questions about how the very systems designed to protect our money can be compromised from the inside. The number at the absolute center of this crisis? A massive 590 crore rupees. That's the total value of the fraud that the bank has reported. And incredibly, it all came from a single branch in Chandigarh.
Now, this wasn't the work of some external hackers. The breach specifically targeted accounts belonging to the Haryana state government. And the perpetrators, they were the bank's own employees. It was a classic inside job. So we're going to examine exactly how it happened, how the bank is responding, and what the potential fallout could be.
All right, here's how we're going to break it all down. First, the disclosure itself. Then, we'll get into how the internal controls failed so catastrophically. After that, the bank's corrective actions, the financial impact and risks, and finally, we'll look at 3 possible scenarios for recovery. So, you have to ask, how does a fraud of this magnitude even happen? Well, the investigation points to forged documents, sure, but the real story here is how those forgeries managed to slip through a security system that had multiple layers that were specifically designed to catch this exact kind of thing. The bank had five distinct layers of defense, and every single one was breached. First, you have the maker, checker, authorizer system. This requires 3 different employees to sign off on a transaction. It was compromised. All 3 were allegedly in on it. Second, the mandatory phone call to the customer for large transactions? Ignored. Third, there was an even higher 4th level of verification for transactions over 10 lakh rupees. That failed too. Fourth, even the branch manager's physical signature check didn't stop it. And to top it all off, an optional digital confirmation, like an OTP, hadn't even been activated on the account. This wasn't just a mistake, it was a complete systemic collapse of their internal controls. IDFC First Bank's own management used a pretty stark analogy. They said, we had a security guard, but the guard himself turned out to be the thief. And that just perfectly captures the core of the problem, right? The very people hired to guard the vault were the ones allegedly robbing it, which makes the whole security system totally useless.
So, faced with this total system failure, the bank has moved pretty quickly to do some damage control. They've launched an external audit and are now rolling out new, much tougher security measures to try and prevent this from ever happening again.
So what exactly are these new measures? Well, digital authorization is now going to be mandatory for all high-value transactions. They're also bringing in AI-based signature verification to add a crucial layer of technology. Any authorization link sent to customers will now expire in just a couple of hours. And to really get to the bottom of this, they've brought in the auditing firm KPMG to conduct a special investigation. So far, 4 employees have been suspended. If you look at the timeline, the first red flag actually popped up back in January. That's when a government department noticed a mismatch in their accounts. By February 18th, the bank had internally confirmed the 590 crore rupee fraud. After a flurry of board meetings, it was disclosed to the stock exchanges on the 21st, and a detailed call with investors happened just a couple of days after that. Now, let's talk about the fallout. The impact here is so much bigger than just the money that was lost. This fraud creates some really significant risks for the bank's stability, its profits, and, of course, its reputation. The total fraud, as we know, is 590 crore rupees. Now, the bank does have an insurance policy for employee fraud that covers 35 crore. That brings its direct financial hit down to about 555 crore. And that's the number that's likely going to show up on its bottom line. So what are the biggest risks? The bank is now facing 4 major ones. First, losing government deposits. The Haryana government has already de-empaneled the bank, which basically means they've stopped doing business with them. Since government entities make up a decent chunk of their deposits, this could spread. Second, there's the risk of panic among retail customers, who make up a whopping 81% of their deposit base. Bad news like this could cause them to start pulling their money. Third, they may have to delay planned cuts to their savings rates, which is going to hurt their profit margins. And finally, all these new security systems and audits, well, they're going to increase operating costs. With all of these risks now in play, the future is pretty uncertain. So let's just walk through 3 possible scenarios for how this could all play out for the bank.
Okay, in the best case scenario, the audit finishes up quickly, maybe some of the money is recovered, and the financial damage is limited to just a couple of quarters. The base case, this whole thing drags on longer, requiring the bank to set aside more money for losses and delaying any kind of stock price recovery. And the worst case scenario? The audit finds even deeper, more systemic problems, leading to higher costs across the board and a very long, very difficult road back to health.
But even with all this information, there are still some huge questions just hanging in the air. On the government side, why were official SMS alerts and bank statements apparently just ignored? And then on the bank side, how long was this actually going on, and why didn't their own internal audits ever catch it? And really, all of this leads to the central question for any investor. The bank stock has taken a hit, but it's not trading at fire sale levels. With so much still unknown, the real question is this: does the current stock price truly reflect the massive risks that still lie ahead?